Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, June 22nd, 2022. What I'm going to do is a quick overview of the things I like and kind of share my thoughts as to what kind of mode I'm in right now. And that's I've been morphing over more into a back into swing trading mode, having covered shorts recently and reversed back to long on the equity markets, but then just recently pivoted on some of the other things that I was short on. So for the most part, I'm just going to give the list right now. Pretty much everything we ended last week with, my outlook hasn't changed. I'm still bullish and long equities, also bullish Treasury bonds. I think there's more upside there. Whether you want to take it or not, you don't get rich on treasuries, but it could certainly be a trade. I'll go over those here in a second. Precious metals and the euro. Euro goes up, and that tends to be bullish for precious metals. And they're kind of not really moving, but they're not going down either. But they're still on I'm just going down the line here with bullish versus bearish. Bitcoin, I still think there's a pretty good chance for a decent tradable rally, and that means well into the double digits if correct, because I think we're be entering back into a risk-on environment. Risk-on means you want to be bullish equities or long equities, and Bitcoin will probably follow as well. And then, as I got a post out to you this morning, oil has now hit my final target. We've been short that one from right off the highs. Natural gas hit my final target yesterday, so I've reversed both of those and bullish and long those. I'll get to those charts. So it really doesn't leave a lot that I'm bearish on right now. The U.S. dollar, obviously, being bullish the euro. And coal stocks, here's the thing. They might have a little more downside, but it's I certainly wouldn't add to those positions now. They're up. Time permitting, I'll get to them. I might cover them in a separate video, but they could continue lower. I'm looking at the charts. I can't make the same case to trade a bounce, play a bounce in those that I can on oil and gas, as well as the energy stocks, which I need to get to as well. I'll also do an update there. So that's a lot of stuff. Let me just run into it real quick. Go through, start out with the equity markets. This is QQQ daily chart. And again, remember, overall trend is still bearish, but we have these nice positive divergences, and that right there, you can see, and we had a bullish falling wedge. We had one breakout that didn't stick, but then again, we pretty much came in and back tested. Now, what I want to show you here is, this is a chart I started working on yesterday. You see a lot of colors here, a lot of boxes, and what you're looking at here, you have a green box right here. I'm going to box that in. That's a gap. So you have a gap right here. You have a gap right there, and there's the box for it. You have a gap right here. It's been a gappy little market. This is what happens with volatility. So you can trade these gaps. I just wanted to highlight how well they work for an active trader. So let's start out with this one. We'll go in order of how they happen real quick. So you had a big old gap right here. And as I mentioned recently, we had resistance there. So this is how one can either actively trade if you want to try to extract or milk some money from the markets as an active trader, short-term swing / even day trader, meaning in and out in a day. It's amazing how well these gaps work, especially in a volatile environment. It brings out the traders like me, the active traders. They have a field day with things like this. So what you can see is you gap down right there. There was the beginning of the gap. You went back, perfect back test. You could have shorted the initial the bottom of the gap there. It's the top and the bottom of the gaps that act as resistance. Boom, boom. So 3 distinct failures again at the bottom of the gap. Then finally you entered the gap, and this was unusual. Usually you're going to make a backfill or near backfill. I always say this, if you're going to target the backfill of a gap, don't go for the exact penny on the high. Take your profits if that's what your plan was, just to simply get a backfill of the gap a little shy. Now I will say this one did fall a little shy of the top of the gap, not where I would have expected it to reverse. It's unusual, but you do see that once in a while. We've backfilled about 80% or so of the gap. But then we went up to set up this gap right here, And where you measure the gap, it's subjective. Technically, it's where the market closes one day. Right there was our close, and where you open the next day. Now the open's right there. I like to look at the candles, and I'll just kind of sometimes use the bottom part of a candle, which is a shadow, a body. But again, this one pretty much covers the close the previous day and the open. And then you can see what happened here. You had a gap up right there from that previous day. That was the 15th. And then once you establish the top of that gap, back tested it again, and then we entered the gap. Finally, right here, we made almost a perfect backfill. So there it is. So once you enter that time, you had a halfway backfill and then a spike up. But once you entered the gap again, you did backfill. Then that set up this next gap right there. And so I just wanted to say that most gaps, what I meant to say, are usually backfilled. Market doesn't like to leave any unfinished business. That's not a hard and set rule. It's just a usual. Usually means more than 50% of the time. Okay, it doesn't. Can't assign odds to it because those odds change in different market environments. But you can see that one was backfilled. And then the next gap was right here. These purple lines. There was a close right here, and you opened all the way down here. So this purple box is the next gap right there. And let's talk about that one. So you had, once we gapped down, you backfilled it, and there was an objective area to close any longs or short, or just notice the price action. You got rejected. Tried to enter the gap, feeble little attempt, pretty much traded on the bottom of the gap, got rejected. Then finally, you parked it right here. And the next day, guess what? You popped up and opened right on the top of it. So you made a complete backfill, but you actually took out the top. Remember, the top and the bottom of these gaps, top right here and bottom, act as support and resistance. In this case, since you gapped above it, you broke above resistance. That's a breakout. And then you had a rally, which took us up to, you got it, this top of this gap. Remember right there. Rejection, rejection. This is where we traded yesterday. And again, I know there's a lot of colors here. You'll just have to, this is a 5-minute chart. I'd recommend to replicate it on your own and take a look at that. So you had, again, the top of the gap was there, which is what acted as resistance all day yesterday. We had a brief overshoot in the beginning of the day. And then this was another gap, the top of a gap that came into play and acted as support right there. All right, so at this point, yesterday, what happened, we closed right on the bottom again of support right here, this level about 281. And then we gapped down today, and look where we gapped down, right to the top of a more recent gap. I'm going to turn these levels off because I know it's hard to see in the video. So this was our most recent gap right here, right? There was our most recent gap, extended out, and this is today's gap. We gapped down to the top of the gap, so that would have been a logical place to step in and buy at the top of the gap. If we started doing this today, then your next support level would be the top of the gap, which is, you can use the top of that candle, you can use the bottom, or you can look where the actual close was, which was 274.70, and that would be the bottom of that red candle right there, but give or take. So that would have been your range right there. But what happened? We successfully held it. So by the way, so bigger picture, again, that's kind of a takeaway, how to trade gaps. You can use these strategically or tactically. Let's say you share the same mindset of me right now, that we're looking at probably a nice tradable bounce in the markets here, swing tradable, trend tradable. Then what you can do with that is use these gaps tactically to add to or build a position. Let's say you're scaling into longs, and you can use pullbacks to top or bottom of gaps. And then the bigger picture, or a different way to view things right now, is you have this uptrend right here. You have a near-term uptrend forming now in the Nasdaq 100. An uptrend is simply defined as any security making a series of higher lows and higher highs, and that's what this is. Boom, we just took that out. So that helps. Today took out yesterday's high, So, me and my little check boxes. So this helps to firm up my bullish case. And next thing I want to see is this previous high from the 15th get taken out, and that'll be the next check box. What I don't want to see, it's not the be all end all, but it certainly starts to chisel away or chip away at the bearish bullish case. I don't want to see this major reaction low get taken out. And then if that one does, I don't want to see this one get taken out, and so forth and so on. So that's it. Nothing's changed. There's the Qs. I'm still overweighted the Qs. You want to look at the Nasdaq 100 real quick, the futures. Let me turn volume off. I was looking at something this morning. Here's the uptrend line. We had a little minor trend line here, but I wasn't crazy about it because they had a violation there. This is the current trend line right now. We have three distinct reactions. So if you are an NQ trader, you can watch this trend line. What does that mean? Well, you can buy pullbacks to that trend line, or you can use that to set a stop below. And that's the trend line off the recent lows, which was also, keep in mind, a divergent low. This is the 60-minute chart. So we just popped. Remember, these yellow levels were the important, significant levels to me. When that one was regained, that was bullish, because we have now this proved to be a bear trap, aka whipsaw, failed breakdown, whatever you want to call it. We successfully back tested that level. That was my big 11.288. I called it 11.290 support. And now this is the next one, 11.704. I'll call it 11.705. I want to see get taken out. That's a pretty big level as well. You've got some gaps to contend with here, but I'm still eyeing right now, preferring a swing up to at least this level. And again, what I said in the beginning of the video, more in swing trading mode. I might average in, or me, I'm kind of ebb and flow. Sometimes I'll take partial or even full profits at a resistance level, and then if I think there's going to be a pullback, and then maybe short it or buy back in on the pullback. But at this point in time, I'm more apt to just kind of, at least with core holdings and IRAs and less active trading accounts, sit tight. And if anything, add to those positions if and as each of these levels are taken out and the case firms up for a much bigger rally. Because I think as it becomes apparent to most, you're going to see more and more short covering. Those shorts, there's still some that were trapped in that took that breakdown, thought the market was going to go a lot lower. And the way this works is they tend to get squeezed. Plus, it brings new money into the market, longs, natural buyers. Shorts are, we'll call them unnatural buyers. They're forced buyers. When they have a short position, they must cover that, whether they're going to cover it for a profit at lower levels, or they're going to cover because they're getting squeezed out at a loss. But then their buying begets more buying. It's a vicious cycle. As they cover, prices go higher because that adds buying pressure, and then that tends to help you break above resistance levels and firms up the tape. The price action, and then it brings in more some of the bulls that were sitting on the sidelines that were afraid to step in because they don't like catching falling knives, but they want to buy when they see signs of recovery in the market or stabilization. Okay, and in the order I mentioned it, Treasury bonds, there's ZB. I threw this one out to you last week. It gave a fundamental reason as well as technical reason. Long-term rates at resistance, most importantly, but then short-term you had the 60-minute bullish divergent low, positive divergence, rallied up. We just recently took out this trend line. I can even probably tweak it now and add a secondary trend line right about here. But there's also that target I think I laid out for you a week ago. That's 136.080. I need to make these levels a little bigger so you can see them in the video. That was and still is an initial price target. You've got some divergence here on the PPO, but not on the RSI. And again, this is just if you wanted to be either hedged to your equity long positions, that is, or a pure play. And then let's not forget the bigger picture, TLT, that's the ETF for the 30-year for the long bond. Big positive divergence there, really nice positive divergence, and then a downtrend line, and that resistance, that was that initial target I gave you, 113. So if we pop 113, we're going to probably head up at least to that next target, 118.51 right there, potentially more. But again, right now I think the there's more meat to be made, at least percentage-wise on the equity markets. But again, it's all about beta-adjusted position sizing. You can take a lot bigger position in TLT. But the fact that I am expecting a rally in the equity markets, that in itself should give a headwind. Now, a headwind doesn't necessarily mean something goes down. It just means it would be a headwind to the bullish, setup here, because if I'm right about us going back to a risk-on environment for a while, those risk-on assets or equities you want to have. I think Bitcoin can participate, other things like that. The risk CLT is traditionally a risk-off asset, but remember, the Fed turned the market upside down on its head with so much excess manipulation, including but not limited to bond purchases. And everything else. So who knows what happens. I trade the charts. What I'm trying to get at is trade the charts for what they say, not what you think might happen fundamentally, especially with an extremely heavily manipulated security such as Treasury bonds. Market usual fundamental forces. There's a lot of cross currents, like I said. In my case, there's the whole inflation trade thing, which has caused rates to go up. Remember, when interest rates go up, bond prices go down, and vice versa. But the case that I made is, I think those in the know might see that we're heading into a slower growth environment, which will help offset inflationary forces especially on the long end of the yield curve, the long-term rates. All right, what's next for you? I mentioned, let me do an update on precious metals. I might as well. Gold kind of hanging in there. Remember, my bigger picture is looking at the weekly chart here. I talked about this symmetrical triangle right here. We broke out, came in and back tested, and we're still consolidating recently. Like I said, gold's not going up, it's not going down the last few weeks. These are weekly candles. Needs to pop about 174 to run. And, better fish to fry, I think, right now. But again, I'd rather be long gold at this point in time than short. If it breaks this below this bottom of the triangle, this trend line, and especially that 164.80-ish level, that's where it's not going to look good. But again, not one of my favorites right now. Just trying to give you an update there for what it's worth. You have other metals too, like palladium. Palladium could run. You have a little downtrend line right here, PA, palladium futures. This is a 3-month, 60-minute chart. There's your downtrend line if you want to replicate that. That comes off I'm using the highs from about April 20th or so right there. And if it pops there, you've got targets right here, up to here. I think about 2080. That's about 2090 right there. Is what I'd be looking at on palladium. Let's talk about the other ones, oil and gas. All right, so couldn't have called these much better. The top, it's, I won't say I nailed the top. We was, more of a scale in. I listed multiple opportunities. These divergent highs were short here at this one. I know that. Highlighted that one, the break of that trend line, which was right off the tops. We went in to make a marginal new high. I posted again an update here that day. We had a strong rejection off that marginal new high. See, there's a little bear, what we call a bull trap. These are what I call the JCL longs, Johnny come lately. They didn't want to buy crude back here. Whoever bought crude there was the bag holder. They bought that breakout to new highs, thinking it was just going to go up because it took out the previous high, but they didn't realize that was a divergent high, and by many other things on the chart said crude probably going to go down. It went on to break out the secondary trend line, hit my first target, second target, top of my third target zone, bounced, hit the bottom of the third target zone, had some consolidation. Then I added this, which was really T4. So again, I didn't bother resequencing these. On the 14th of June, I added this as a new target. Hit to the button. Again, active traders can game these bounces. Then yesterday, I updated right here, said still favor to move down to the T2. That was a nice add-on. I added some CL shorts there. And then, as I told you this morning, I covered on the trend line. T4 was the first of the uptrend line, which goes all the way back here. There's multiple reactions, even to the left of this chart, not just these three right here, now three distinct ones. And again, if it breaks down, I can add two, but not below that 100.88 or 190, whatever you want to call it. If it can rally up here, which I'm leaning towards, or I wouldn't have reversed, I would have just covered. uh, you have a potential positive divergence right here. You can see the indicators making higher highs with prices making lower lows. This would be your divergence line, I'm sorry, right here. Positive divergence. So this minimum, I'd be looking for a rally, or I am looking for a rally up to back to that former target up there at 106.42. For now, that's all I'm looking for. And if I get that, that'll add on another 5% on top of what I've milked out of it on the way down here to this point. And if it craps out below there, maybe there's bigger things in play for crude oil. Wouldn't surprise me, but as of now, that's what I'm looking at. NG, same thing. Called this one with near impunity down to my final target right there at 653. And multiple entries here, multiple bounce backs, including the most recent where I was really harping this one. That was a nice, this is what I call one of those golden shorting ops, when you get a rally back to good former support, then resistance. And that was good in just a week. You got an extra, whatever that was, that big drop down there. It's a big move. Natural gas is down, what, 50% almost? It was topped out here at about 968, almost 970, and it just hit my final target of 653. That's close to a 50% drop in a matter of weeks. And then you've got this nice bullish wedge. So that's why where I was short up until yesterday when that hit, and now I'm long. I was long yesterday, and I added to those longs today. We had a breakout and a back test of this bullish falling wedge pattern. So I think we can have a nice rally there. And if it craps out and drops much below my 653 support, well, so long. Lost a little on this long trade, but that's where I'm at right now on that gas. Let's see. Energy stocks, let me follow up on those. My thoughts on crude. If crude and nat gas bounce, that's going to be net bullish for the energy stocks, so I have covered those at some of those ETFs like DRIP and whatnot. Here's XLE. It is at trendline support, which was my next target right there. That's a long-term uptrend line, a very significant uptrend line with solid price support just below at 70.50. So I would be at the very least trailing stops down, if not outright covering the energy sector shorts right now. Ultimately, I do think they go lower. It's just a matter of, do we bounce first? If I'm right about the equity markets, which so far that's playing out, that's going to should give a tailwind. Remember, this was the last sector to hold out, and this is that crowded rush for the exits that I warned of. I said it's a beautiful thing to be short, very painful if you're long, to be in a crowded trade, but I love shorting crowded trades, and this is what happens when everyone tries to run for the exits at the same time. You get that panic selling, so that's it. So anyways, from the breakdown right here, which was highlighted, on XLE, that's big energy. It's down 20% in a matter of just a couple weeks. To me, take the money and run. Game of bounce, get back in. Maybe it keeps falling. I don't care. I'm out. Covered I covered my drip today and everything else I had. Let me show you. Drip is just XOP in reverse, 2-time leverage. XOP is the oil and gas exploration and production sector. That was my next target, 124.81. Hit to the button today. Low was 125.14. Close enough when you look at it. Again, I don't look at those are the actual support levels. Always cover above the support level you want. There was a breakdown. That was a sell signal highlighted recently. You're talking in just a matter of a couple weeks there, about a 25% drop. And then drip, as I say, that leverage works in your favor instead of against you. Just from the lows, okay, the breakdown was right here. This was when XOP broke out. So I'm not going to grab the very bottom. I'm just going to grab that around where we broke out. And you can see up till today's high, which was when XOP hit support, my price target lows, that's about a 63% gain. So congrats to those that caught that one. But for me, I'm out, taking profits there. I might even reverse it, but right now, I'll just trade the crude and nat gas longs directly. I'm not going to buy the energy stocks right now. And then the other one was XES. XES is broken support. It's kind of in no man's land. But again, pretty darn oversold and down. Nothing but waterfall selling. This is exactly what I was talking about, that rush for the exits on a crowded trade. You can see what happened to the bag holders that were buying, energy stocks up the highs or still holding on to them, in despite of, very clear bearish technicals, the big divergences. That's a 26% drop off that big divergent high right there. Divergent high 1 dropped, divergent high 2 was even bigger, and as expected, the second drop was even bigger because you had the bigger divergence at that point. All right, that's it. Coal stocks, like I said, I'll do those in another video, but that's it. Let's keep it simple. Not much else to add. Equities. Oh, and I still favor the Nasdaq 100 for equity longs at this point in time. And on a final note, don't fall in love with anything. I'll give you my thoughts. I give you my convictions. You can usually hear it in my voice whether I have strong convictions or not. Give you my strategies, whether it's a hard buy or a scale in. But the one thing I want to say is, I don't fall in love with anything in this market. We are on long-term sell signals on the longest term charts. I go out to the weekly and monthly charts. We are in a bear market, and I still have additional downside targets. While I'm more than happy to game counter trend rallies, and they can be pretty powerful, I don't get married to them, and I remember the big picture here that long-term the trend indicators are bearish, but we also fail to remember QQQ, my long-term primary uptrend line. This yellow uptrend line is one of the most significant levels on the chart. It's the long-term, what I define as the current bull market that we're in, and still in by that metric because we haven't taken it out. Lots of reactions. Every big drop, which were corrections or bear markets in the last since 2009, so over the last decade, have all brought us back to that level, including this one. So ultimately, I think it goes. We took out the 20-month exponential moving average. It's just a matter of, does it go without even a reaction off at first, or do we bounce first and then take it out maybe next month or in a few months from now? It's kind of the way I'm leaning. All right, guys, I'm going to wrap it up here, get the video out to you, and if anything else changes or I see any other trade ideas, I will let you know. But there's a handful for you now, long equities, long oil, long gas, and that in itself, should be enough if those play out for trade ideas. And then, of course, the individual ones I don't need to go over again. Zoom, I've covered a lot lately, one of my favorites. Taken out T1 finally. That's a breakout today, so this is going to open the door for a move up to T2. This one we're quite profitable already. Been profitable. It's just that consolidation around the initial reaction on T1. And look at that. It's been pushing against that level for a while. Broke out. I still very much like Amazon as well. Facebook's looking good to me, or Meta now. They even changed the ticker finally. Amazon, that big divergent low, even bigger on the second pullback right there. I don't know. This is but again, to be long Amazon is to be long the Nasdaq 100, or they're one and the same. There's Meta, also nice big divergence. This one train has not left the station yet. A little bearish engulfing candle right there, but bearish engulfing candles are not, they're topping sticks, so that really doesn't mean much, the fact we had that yesterday. What'll happen if I'm correct and the Nasdaq 100 keeps moving up, the buyers will eventually step in and buy Meta, and you can see the levels, downtrend line, everything else. But there's others that stand out as well. I'll try to follow up with individual stock picks. If you guys want those, let me know. Otherwise, in this type of market environment, if I'm right and we have a near-term bottom, you're going to see institutions flooding back in, and they're going to want to buy the market leaders. So you can keep it simple by buying QQQ, and then you own Meta, you own Apple, you own Microsoft, you own Amazon, Tesla, the whole lot of them. Okay, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.